Welcome back, investors. Today we are talking about Lowe's stock. As always, I'm going to kind of start with some of the quantitative stuff here up top. A lot of this data stuff you could find other places. I do try to break it out in a longer time period than you'll see other places. If you're going to look at like Yahoo Finance, you're usually going to get just a couple of years. Whereas the way that I'm breaking it down, I'm really trying to make it company specific in terms of what I'm trying to show you guys. If you're not so much interested in the numbers and stuff, you can skip down where I talk a little more about, say, the qualitative stuff. But I am going to look at maybe some of the valuation. Now, Lowe's currently priced around $190. It's October of 23 as I'm recording this, so it may be different when you're looking at this depending on when you happen to click on my video. And I always try to start with some of just a quick glance type things. So ISS governance, audit, board, shareholder rights, compensation. This is more of that qualitative competitive advantage type stuff. There's multiple schools of thought on valuing companies, determining which ones are worth investing in. And so, one of the big ones that Warren Buffett pushes is he looks for honest management, people with integrity running a business. And so I like to look at the ISS governance score here because that's just one place where I can kind of look at least in a measurable way, how might we measure the integrity of a company? And so these range from 1 to 10, of course, 10 being the worst, 1 being the best. And Lowe's actually falls in a pretty good spot, especially compared to a lot of other companies. 2 5s on audit and board. We'll talk about audit a little bit later in the video. And then, of course, shareholder rights and compensation. Compensation not being dividends and stuff, but being compensation of like the board and the executives. So actually falls in a pretty good spot there. Most companies have pretty high ISS compensation scores. As far as profit margin and operating margin, respectable return on assets, certainly good as long as it's in a double digit like that. That's great. Return on equity has an NA, and that has to do with the fact that the last two fiscal years they've had negative equity. We'll talk about that a little bit here in just a minute. Past 5 year growth has been 28.5%. Next 5 years would be about 5.5 is what's projected. Of course, it could totally be different. The past 5 years, a big part of that growth had to do with the COVID pandemic. Everybody staying at home. A lot of people started to work from home. Well, everybody wants to spruce up where they're spending most of their day. A lot of times pre-pandemic, when everybody was working in office, everybody would go to work. That's where you spent 8 9 hours a day. You really only came home to eat, sleep, maybe relax a little bit on the weekends and stuff. That to say, Lowe's really benefited from people working from home because now you're spending all your time at home. You realize, man, this place is kind of a dump. I got to fix this up. So Lowe's really kind of came through on that. That's part of that past 5 year being so high. Next 5 years, a little more conservative. And I think that just has to do with, the economy slowed down quite a bit. That puts a damper on things, and that's going to be for most companies, more on a macroeconomic level of things. But also, a lot of return to office, a lot of companies kind of reneging on, oh, yeah, we're going to let you work from home. We're not going to ask you to come back to office. And now they're saying, well, we need you to come back in. Next 5 years don't look as optimistic, and that you're going to see that with most companies. So I wasn't shocked at all when I saw that here with Lowe's. Of course, operating cash flow, levered free cash flow. My big thing when I'm first scanning a stock, I want to see those numbers at least positive. We're going to do some more comparative stuff with those here later on. But up front, I want to see, okay, we have positive numbers. As far as price earnings, 13, really not a bad spot. Forward, and that trailing was 18. So it's going down. That puts it a little closer to a better value. On the PEG ratio, that's your price earnings to growth. So you want a lower number with that as well. Ideally, it'd be under 1. And 1.12 is a pretty good spot. Really, 1.5 is kind of where you want to cap out at. Price per sales, 1.25. Also a pretty good spot there. As well, the dividends are increasing. I believe it's in 2025. They continue to increase their dividend and keep the dividend, obviously, over the next few years. They should qualify to be a dividend aristocrat. That I think will bring in a lot of dividend growth investors, more of the conservative crowd of investors. are going to want to put in more money into a stock like this. And so that's kind of on the horizon for Lowe's. That's one of the things that kind of interested me about it is that they do have a good track record over the last 20 years of ensuring that they're paying dividends, they're increasing dividends, and they've continued to hold that steady. And if they can continue to do that for the next couple of years, they're in a very good position. Now, insider ownership, there is some, so that's always good. Of course, I like to look at total cash and total debt, both nice positive numbers. Of course, debt is significantly higher, so that's something that I don't really like to see. I like to see a company where their total cash equals or is higher than their total debt, but beggars can't always be choosy. And this is something we're going to talk about a little bit more with this company is their debt load. Spoiler alert, that's kind of my biggest red flag with this company. And so we'll talk about that. The working capital that really gives me the biggest pause when I'm looking at a company like this, because no matter how big you are, working capital, cash, that is the lifeblood of your company. So current ratio is the biggest thing for me. Just off the bat, it's the easiest thing to look at. It's one of the easiest ratios to calculate your current assets divided by your current liabilities. So if we came over here and looked at the balance sheet, we'd go to your total current assets, 14,228 in 2019. And we go down here, we look at our total current liabilities, 14,497, 2019. And so they're basically 1-to-1, which is good. That means that if they turned around, they could pay it all off. I like that it's over one. Here in 2019, when it's 0.98, that's certainly concerning. And I like that it's increasing, but it's not increasing at the same rate that their debt is increasing. And that's really what's kind of gets to me as I'm looking at this. Because you look at this and there's a 23.78% increase in their total debt over the last 5 years, and their current ratio stayed flat. Now, I don't like to see companies where they're keeping that current ratio high, 2.5 plus, making it look like they have a lot of cash on hand, and their total debt is obviously what's floating that. But I definitely don't like seeing a company where they're piling on debt and they still don't have a lot of cash on hand. And so that kind of gives me pause when I'm evaluating companies. The cash generating power ratio, this is one of my favorite ratios. It's just because it's a little different, but it comes over here onto the cash flow statement. Basically what you do is you're going to look at your cash from operations. This is all the cash from just the profit that comes into the company from running it, the day-to-day of the company. And you're going to take the total amount brought in there, and you're going to figure out what percentage of all the cash that came into the business came in through the actual selling home renovation material type things. And so you're going to take out your divestitures, you're going to take out any long-term debt you got, your short-term debt, and then of course here we got 2 years where they had some foreign exchange rate adjustments, which I don't care so much about that, but I want to see what percentage of the cash flowing into the company is actually coming from what the company exists to do, which is make money. And so we see that that's decreasing significantly over the last 5 years, and that is concerning for me as well. Very concerning. I'd like to see it right here around 96% at least, because that tells me that the company, just by existing and running its business to do what it does, is being successful enough to pay all of its bills, regardless of whether it issues more debt or it's doing anything else. A company that owns stores like this, if most of their money's coming in from, investing activities where they're investing in marketable and equity securities, that's not what I want to see, because I want to see a company like this that's making money from, retail, because they're a retail company. And so if they're not able to do that and they're having to start to get a little more speculative, this ratio is a nice place to be able to see some of those concerns show up. Of course, quick ratio is the current ratio. If you take out the inventory, they have hardly any cash on hand. They have a tenth of what they need and what they have for the next 12 months to cover what they owe in the next 12 months. And they have for the last 5 years, gives me a pretty clear picture why they might be piling on debt. Moving ahead, inventory turnover, something I look at a lot with retail companies. Of course, with your turnover, you want to see 4 plus. They're at least close to 4, so I'll give them that. Of course, on days inventory, you want to see it less than 95. They are moving the inventory. And it's not like it's at like 150. So it means the inventory is not, it's not sitting there in a glut, but also, they could be a little more efficient moving the inventory that's sitting in their hands. As far as operating cash flow ratio, this is where you take your cash from operations and you divide it by your current liabilities. Again, looking at the money that came into the business, is it enough to actually pay the bills through the normal channels of the business? And here we see it's usually only about half of what they need. And, it has increased over the last 5 years, but you have a weird spiky pattern. So as far as capitalization, again, I'm probably not going to sit on this too much, but the big thing I want to look at here is here in column row 94, total debt. We just see that it's stacking up. So of course their tangible book value has gone down significantly. Their debt to assets, their debt to equity, definitely becoming almost 1-to-1 debt to assets. So that's a big problem. And of course, their equity as well has gone negative. Because if I'm buying a business, what I'm getting is actually the equity. I'm getting what's left over. If you wipe the slate clean of assets and liabilities, this is what's left over. Theoretically, the profit of the company. I could see a company taking on a lot of debt, but I'd want to see their capital expenditure increasing at least semi proportionally to the amount of debt that's coming in, because then I might be able to kind of lean on saying, okay, well, at least I trust the ownership of the company. They're bringing in debt, but they're also investing. I think it's going to pay off. Therefore, I'm willing to buy shares of this. The problem is, yeah, it has increased by 11.7% over the last 5 years, but that's not even really half of what debt has increased to. So that's problematic as well, that they're bringing in debt and they're really not expanding the company proportionally. So this is the big bright spot of Lowe's when I'm looking at this company, is that profitable. I mean, earnings per share continue to go up. That's, obviously based on your net income. Revenues, 8% increase. Gross profit, almost 9% increase. So, they've increased revenues, but they've also decreased operating expenses or cost of revenues. So that seems to be good. And then their operating margin's gone up by 16%. So it seems like at least that part of the income statement, if we go over here, here they've increased this, but this is increased more, which means that when you take these out, this is even smaller of a percentage of this. So that's a really good thing. And of course, return on assets, really not bad. And it is a little better now. Here, 16.25. So it is improving significantly. So I think that's a solid place. And of course, return on equity has, you can't really measure it because equity is negative. So that's problematic for me. Again, that's what you're getting when you're buying the company. Now, as far as distributions, again, a lot of people might look at Lowe's as a viable option if they're looking for dividends. And so a lot of people, if they're going to look for dividends, they may not even look at this stuff. They'll look at the price earnings. They'll look at maybe revenues and profit, maybe even operating margin if they're really going to actually look at margins. And then they'll maybe look at a couple of these things, probably the payout ratio or dividend coverage ratio, and they might look at like free cash flow where they'll see positive. So this is all they'll see, and they'll say, yeah, Lowe's is a great stock to buy. But for some reason, people, when they evaluate stocks, tend to skip over this because maybe this is harder to understand, especially the capitalization thing if you haven't worked in finance before. So there is good to this. I definitely don't want to seem like I'm bagging on Lowe's, like you shouldn't invest in Lowe's, but definitely some positives when you really get down to it. And of course, distribution. So the payout ratio, that's your dividends divided by your net income. What percentage of your net income do dividends make up? The dividend coverage ratio is the inverse of that. And so that's going to be your net income divided by your dividends. So whichever one you choose, people might talk about different ones, but whichever one you choose, they're the same thing, just flipped. So that has decreased. You want a lower number. So that's a good thing. It did bounce up a little bit over the last year, but still not terribly concerning there. So I'd say the dividend in terms of the payout ratio is safe. Free cash flow to equity, that's its own thing. It's basically, if you can see over here, your cash from operations minus your capex plus the debt issued minus the debt repaid. Then I divided it by the shares because we wanted to look at per share. And then we divided it by dividend per share to decide how much free cash flow to equity would cover the dividends per share, and plenty of margin there. So still doing good there. And of course, that does include debt issued. So I think if we took that out, this number may not look as good. And that's kind of where we come here. Net debt to EBITDA. That is going to measure your leverage, and a rising ratio indicates the potential for dividend cuts. So of course here, it has stayed. I mean, you see these big bumps and stuff, but really it's relatively flat. It just, again, is showing that their debt compared to the actual profitability of the company, these are going to be two things in tension for a while. This is the auditor's statement about their concerns. So they received these. Many of the vendors' funds associated with these purchases are earned under agreements that are negotiated on an annual basis or shorter. Funds are recorded as a reduction to the cost of inventory as they're earned. As related inventory is sold, the amounts are recorded as a reduction to the cost of sales. So that may be one of the ways where they're able to keep a flow of inventory, but also keep the cost of sales down, is through something like this, where they basically have factored in these side agreements. So, this was something that was listed as a critical audit matter. That would be something that I would want to dive into. Again, when we see issues with working capital and then we see issues with debt, well, again, they're banking on the profitability side of things. So some of this, I think, comes into play with that. I didn't realize this, but Lowe's only operates in the US and Canada. 90% of their revenue is generated in the US. Home Depot is much more global. And I think that's really the big positive and strength of Home Depot in comparison to Lowe's. And all their debt is sub 5.5% until 2053. So it kind of makes sense that they would pull in so much debt now because they see rates going up over the last year and a half. Of course, this is a 5-year trend, but we'll give them the benefit of the doubt and say, well, until 2053, really most of their debt is going to be relatively low for a while. I thought it was interesting. Their CEO was former CEO at JCPenney, former exec at Home Depot, former exec at Target. He's kind of an interesting guy. And again, it's important to go do some research on who actually runs the company day to day. So coming over here to my stock valuation calculator, there's a link to this in the description and then also up in my bio. But basically, we type in, we can type in Home Depot and it's going to change. But we're going to just go back over to Lowe's. I put in a positive book value per share because, if I put the negative $25 or whatever it's worth, then we're going to get some weird numbers. I guess I'll leave it. Coming over here. So depending on how aggressive or conservative we want to be, and I put varying margins of safety one might have. The value for the stock ranges anywhere from 193 down to 91.44. Now, I think my lower range of things is way off. I like to use a discount rate of 25% because it really cuts the value in half. So definitely probably, mentally filter that out. But I'd say somewhere in this 190 to 180 range, probably higher than 130 as well, but somewhere probably 150 to 193, I say is fair. Again, I want to look at more things than just, I want to get a number and decide if I'm going to enter or exit, those kinds of things. I'm not a trader. And then also, I want to look at this stuff. One might say, oh, this is quantitative because it's just looking at numbers. But for me, these numbers paint a picture and really gives a qualitative story to what's going on at the company. And so, lastly, of course, we can go here and look at peers in Seeking Alpha. And here, the comparisons it's got is with Lowe's to Floor and Decor Holdings, Kingfisher, Betterware of Mexico, Tile Shop Holdings, and Grow Generation Corp. Now, I want to add Home Depot because again, that's their biggest true competitor. So I want to look at Home Depot and compare it. Now I'm going to take out grow generation. Leave it at that. So some similar companies. And really, if we're looking at the blue and the orange, you can see how they basically track right along with each other in terms of price. So their price performance very tied together, again, because they're such close competitors. I think even if you looked at a 5-year, Home Depot's had a higher price overall, but no, I apologize. Lowe's has had a higher price overall. They got orange and blue for companies that are orange and blue, but either way, the prices really move in tandem together. So sometimes it's nice to add in some of these others that really I've never heard of and kind of compare, like maybe there's better options out there. And of course we can look at different things here. Of course, EBITDA margin, right? Profitability of the company. So we'll look at Lowe's. We'll look at Home Depot. Home Depot obviously has maintaining a much higher percentage there. Net debt, right? So looking at the amount of debt minus the amount of cash on hand, and both Lowe's and Home Depot have kind of followed the similar trend. Something else to consider is that maybe it's not isolated to Lowe's. Maybe we can't totally fault them for the situation they've got. We're looking at 36.8 billion for Lowe's, 46.68 for Home Depot. Maybe we want to go look at Home Depot and look at their financials, to look at their balance sheet and see, okay, maybe this working capital situation that I've harped on a little bit, maybe it's typical. So 18,529 up to 32,471 and 16,716 up to 23,110. So no, definitely not close to 2, but still I would say better than where Lowe's has been at. But definitely something to consider. If we're looking at valuation, again, I don't need to be able to see the score because I can see the sector median here. I can see Home Depot here, and I can just compare them. And so that's the nice thing about seeking alpha is you don't have to pay for all the extra features because some of it can just be inferred if you know what you're looking at. The dividend yield higher, trailing 12 month than the sector median. And if you go and look at Lowe's, something I looked at earlier, 2.23 compared to 2.5. So maybe room to grow and room to, improve. A lot of what I've talked about here, maybe I'm raising red flags where if you compare it to others in the same industry, they're facing the same headwinds. And so they're on track with them. The goal, if you're value investing, if you're trying to pick individual stocks or, building your own portfolio, is not to find companies that are slogging along with the rest of the competition, but companies that are in the same industry as others that are way outperforming their peers. And so in that sense, I would say, even if it's the case that Lowe's, Home Depot, they represent what we should make the benchmark to be, and they're right in line with them, and they're acceptable investments as a result of that, well, I still want to see something better than what I'm seeing here. Well, that is all I have for you guys. I really appreciate your time, your patience. If you've made it this long into this video, thank you so much. If you have any questions, concerns, comments, if I just made a total bonehead comment or something, drop it in the comments and let me know. I try to respond to those as quickly as possible. I think I have one still outstanding on my Crocs video, but I am going to get back on that. I try to respond quickly. Again, if you like, comment, subscribe, those kinds of things, and you're following, what I'm doing, and I'm hopefully providing you some kind of value, then, if you're going to take the time to write something to me, I'm going to make sure I take the time to write something back. But that's all I have for you guys. As always, dig in, invest well, and I will see you next time. As you